So good evening, all of you. Our topic is IFRS 5. So non-current asset held for sale and discontinued operations. Non-current asset held for sale and discontinued operation. So that is what IFRS 5. So in this we are going to discuss two topics: non-current assets held for sale and discontinued operations discontinued operation. So generally, this standard is provided for the requirement for classification and measurement and the presentation of a non-current asset held for sale. Generally, an entity shall classify the non-current asset as held for sale only if its carrying amount will be recovered principally through a sale transaction rather than the continuing use. So what is that meaning? For example, if the non-current asset is there, so generally non-current asset is recorded at what price? At cost price, and subsequently it is recorded at a book value. Then how to recover this book value, how to recover the cost of the respective non-current asset? Only two ways are there. One is by usage of the asset, and another one is by sale of the asset. We can recover the cost of the asset or carrying amount of the respected non-current asset either by usage of the asset in the process of production or for providing the services in the ordinary course of the business, or second option is sale of an asset. If the asset held for usage or held for usage in the ordinary course of business, then it is recognized as a property, plant and equipment and is accounted as per IAS 60. But if the carrying amount or book value of the asset is recovered only by sale of the asset, if the carrying amount or book value of the asset is recovered only by sale of the asset, then that is called as what? Non-current asset held for sale, non-current asset held for sale and is accounted as per IFRS 5 and is accounted as per IFRS 5. So non-current asset held for sale is nothing but those non-current assets whose carrying amount or book value of the asset is recovered only by sale of asset. Is recovered only by sale of asset, then we classify that non-current asset as held for sale. Non-current asset as held for sale. Then when we consider the non-current asset as held for sale, if it satisfies the two conditions, if it satisfies the two conditions, the first one is that asset must be available for immediate sale. That asset must be available for immediate sale. Immediate sale, and another one is sale must be highly probable. Sale must be highly probable. Sale must be highly probable. That asset must be available for immediate sale. Nothing but at the present condition. So we are going to sell the respected asset. And another one is sale must be highly probable. So when we say the sale is highly probable, when we say that sale is highly probable, if it satisfies the following conditions, if it satisfies the following condition, we say the sale must be highly probable. The first one is unlikely that the plan will be changed. Unlikely that the plan will be changed So nothing but the management does not change their plan to retain the asset. The management should restrict it to the plan to sell the asset. Should restrict the plan to sell the asset, and the management should take the action regarding the sale of that asset. And price should be based on fair value. For example, if the fair value of the asset is around 1 lakh, around 1 lakh, but the management fix the selling price, as 1 lakh to 20,000, then in that case, no person will purchase that asset. So clear here, the clear picture of the management is not to sell the product, because if the party who wants to sell the asset, he has to fix the price either at market price or less than the market price, and don't fix at a price more than the market price. Here, the fair value of the respected product in the market is 1 lakh, but the management fixed the selling price of the respected asset at 1 lakh 20,000. Means the management has no intention to sell the asset at the present under present condition. Then that asset is not classified as a non-current asset held for sale. So price should be based on what? Fair value. Price should be based on what? Fair value. And the third one is management should be committed. Management should be committed to sell. Management should be committed to sale plan. Should be committed to sale plan. So management should take the action in such a way. Management should take the action in such a way to sell the respected asset. If the management fix the price in this way, so then that shows clear intention of the management that the management has no intention to sell the respected asset. They must be committed to sell, and they must be committed to stick on the respected plan for sale of the respected asset. And the fourth one is, so we are actively looking for a buyer, and sale is the last one is sale is expected to happen within a year. Sale is expected to happen within a year. So if these conditions are satisfied, then we say that sale must be highly probable. So we classify the classification of the asset under non-current asset held for sale is possible if it satisfies the respected two conditions. The first one is asset must be available for immediate sale in the present condition, and the second one is sale must be highly probable. When we say sale is highly probable, only if it satisfies the respected five conditions. The first one is unlikely that first one is what? Unlikely the plan will be changed by the management. The management should be stick on respected plan to sell the asset on. The second one is price should be based on the fair value, nothing but market price. And the third one is management should be committed to sale plan. And the fourth one is actively looking for a buyer. And the fifth one is sale is expected to happen within a year. If we satisfy these five conditions, Upmas, then we say sale is highly probable. If these two conditions, asset is available for immediate sale and sale is highly probable, then we classify the respected non-current asset as held for sale. Non-current asset as held for sale. Clear? Then next one is how to measure the non-current asset. So generally, non-current asset held for sale. If any asset is classified as non-current asset held for sale, then no depreciation is provided. No depreciation is provided. And the second one, it should be it should be valued at carrying amount or fair value less cost to sale, whichever is earlier. It should be valued at carrying amount, fair value less cost to sale. We say fair value less cost to sale as NRV. So why we calculate, why we value the respected non-current asset held for sale at carrying amount and fair value less, carrying amount or NR whichever is less, because the sale is expected to happen within a year. We consider it just like as an inventory. We valued at carrying amount or NR whichever is less. Carrying amount or NR whichever is less. For example, so cost of the machinery on 1/1/2000 X1 10 lakhs. Its useful life is 10 years. On 1st July 2000 X8, that asset is classified as non-current asset held for sale, and market value on 1/7/2000 X8, market value on 1/7/2000 X8 is 3,50,000, and cost to sell the product or sell the respected asset is 70,000. Then show the what is the price of the respected non-current asset. At what price we show the non-current asset held for sale. So in that case, how to calculate? So first here, what is the carrying amount on the date of reclassification? On what date we reclassified? On 1st July 2000 exact. Then what is the cost? So 10 lakh. Useful life is 10 years. Useful life is 10 years. So depreciation is 1 lakh. So we provide the depreciation for how many years? So X1, X2, X3, X4, X5, X6, X7 means 7 years. Plus in X8, we need to provide for 6 months. So 7 years and 6 months. So the depreciation is 10 lakh by 10, nothing but 1 lakh per annum. For 7 years, 7 lakh. For that 6 months, 50,000. So depreciation is for 7.5 month is nothing but 7,50,000. So how much amount is there? 2,50,000 is the carrying amount. 2,50,000 is the carrying amount. Then what is the market price? So what is the market price? For example, here 3,50,000 is the case one. 3,50,000 less cost to sale is 70,000. Then what is the value? So 2,80,000. So 2,80,000 is the NRV. At what price we show either cost or carrying amount or NRV, whichever is less. That is equal to carrying amount 2,50,000. There is no reduction in the value of the asset. So we show at the carrying amount. So value of the asset is equal to 2,50,000. Nothing but what? Carrying amount. For example, in the second case, so same situation, if the market price is 3 lakh and the cost to sale is 70,000. Cost to sale is 70,000. Then in this case, so market price 3 lakh less cost to sale is 70,000. Then what is the NRV? So 2,30,000 is there. So here the carrying amount is equal to 2,50,000. and the NRV is equal to 2,30,000. So whichever is less, we have to show the non-current asset held for sale at a 2,30,000. Means we need to reduce the value of the asset by how much amount? So reduction in the carrying amount by 20,000. Reduction in the carrying amount by 20,000. That reduction is treated as what? Impairment. Impairment loss and is transferred to statement of profit and loss. Okay, so non-current asset held for sale is valued either at carrying amount or at net realizable value, whichever is early, whichever is less. So any reduction in the carrying amount is treated as impairment loss and is transferred to statement of profit and loss and is transferred to statement of profit and loss. So this is about what? Non-current asset held for sale. This is the first part of IFRS 5. And in this case, clearly, so non-current asset held for sale should be represented. So should be represented separately in statement of financial position. Separately in statement of financial position. So next one. Discontinued operations. The next one is what? Discontinued operation. So in case of discontinued operations, for example, the business has, Mr. A has the businesses. So for example, there are three plants are there, X, Y, Z, three plants, major plants X, Y, Z. So here it is a profit venture and it is a loss venture and it is a profit venture. And that person unable to continue the respected Y plant, one of the major plant of the respected party. Then then the Mr. X, Mr. A is intended to discontinue the operations of Y, to discontinue the operations of Y. Then this is called as what? Discontinued operation. And while preparing the profit and loss statement of the respected company, then the net results of discontinued operations has to be shown separately. Has to be shown separately. Then how to disclose? How to disclose? So generally, coming to the statement of profit and loss. Coming to the statement of profit and loss. First, we consider what? Revenue. Then we reduce cost of sales. Then we have what? Gross profit. Then we reduce distribution cost and administration cost and selling cost. Then we have operating profit. Then we reduce financing cost. Then we have EBT. Then we reduce tax. Then we have EAT. So here this EAT indicate what? Profit from continued operations. Profit from continued operation. So we have to add profit from profit or loss from discontinued operations. Profit or loss from discontinued operations. Then we have what? Total profit or loss during the year. Total profit or loss during the year means we have to show the profit or loss from the discontinued operation as a separate line by adding to the profit from the continued operation as an addition to the profit from the continued operation. So here the profit from the discontinued operation, whatever we added, this indicate what? Profit after tax. We have to mention what? Profit after tax from the discontinued operation is only added. Then the question is, sir, how to calculate? How to analyze the profit or loss after tax from the discontinued operation? The analysis of this amount is provided separately in notes on accounts. So we calculated in this format only. So for discontinued operation, the profit or loss from the discontinued operation is also calculated in this format, like revenue less cost of sale, gross profit less cost, operating profit less finance cost, EBT less tax, EAT is there. This is only the format we followed, but the analysis relating to the calculation of profit or loss from the discontinued operation is required to be provided separately in the notes on accounts. Is required to be provided separately in the notes on accounts. Clear? So in this standard IFRS file, we discuss two things. The first one is what? Non-current asset held for sale. Second one is what? Discontinued operation. The classification, measurement, and the presentation of non-current asset held for sale is required to be provided separately in a statement of financial position, and the profit or loss from the discontinued operation is required to be provided separately in statement of profit and loss. But which amount is required to be added or reduced from profit from the discontinued operation is nothing but profit after tax from the discontinued operation. Profit after tax from the discontinued operation is added or reduced from the profit from the continued operation, then we get what? Total profit or loss for the current year. Okay, so this is what IFRS file. Okay. Yes. So here IFRS 5. The objective of IFRS 5 is nothing but the first one is relating to the non-current asset held for sale, and the second one is relating to discontinued operation. So non-current asset held for sale is requirement for classification, measurement, presentation for non-current asset held for sale, in particular requiring such that asset should be presented separately on the face of statement of financial position. But coming to discontinued operation, it should be presented. The results of discontinued operation should be presented separately in statement of profit and loss. Here, the remember results is nothing but profit after tax. Only results required to be mentioned separately. And the analysis of the results is shown separately in notes on accounts. Next. So classification. How can we measure? How can we classify the asset as a non-current asset held for sale? It has to satisfy the two conditions. It must be available for immediate sale in its present condition. Sale is highly probable. So for sale is highly probable, it has to satisfy these five. Unlikely the significant changes will be made and the plan will be withdrawn. And the second one is, so prices should be at fair value, reasonable, actively marketed at reasonable price. And the third one is so that party committed to management or committed to plan to sell the asset, an active program to locate the buyer, and the sale must be done within 1 year from the date of classification. Next, how to measure? That asset is measured at what? Carrying amount or fair value less cost to sale is called as what? NRV. Carrying amount or NRV, whichever is less. So it should be presented separately on the face of statement of financial position under what head? Current asset, because the sale must be done within 1 year and it is not depreciated. So where the asset held under revaluation model, where the asset held under revaluation model. In case of revaluation model, either we follow IAS 16 or IAS 40. If it is an asset relating to the property, plant and equipment, we classify it under IAS 16. If it is relating to the investment property, we classify it under IAS 40. Then, so on 1st January 2001, Mitchell Co. bought a stamping machine for 20,000. It has an expected useful life of 10 years and nil residual value. On 30th September 2003, so Mitchell Co. decided to sell the machine and start action to locate the buyer. Sell the machine and start action to locate the buyer. Means that party classify the asset as a non-current asset held for sale. Machines are in short supply, so Mitchell Co. is confident that machine will be sold fairly quickly. In its market value on 30th September to 2000 X3 is 13,500 and it will cost 500. In this case, first we need to classify, we need to calculate what is the carrying amount on 30th September 2000 X3. First, cost of the asset is how much amount? 20,000 is there. So less depreciation. We need to provide the depreciation for how many years? 2000 X1, 1 year, 2000 X2, 2 years, and in the third year. So for the third year, what is the depreciation here? 20,000 by 10 is equal to 2000. Is equal to what? 2000. In the third year, so means in the year 2000 X3, we utilize that asset for how many months? 8 months. Sorry, 9 months. Utilize the assets for how many months? 9 months. So we provide the depreciation 2000 for first year, 2000 for second year, X2, X1 and X2. In the X3, we need to provide it for 9 months. So So 2000 into 9 by 12, 1500. 2000 into 9 by 12, 1500. So what is the total? 4 plus 5. So 5,500. Then carrying amount equal to 14,500. Then what is the cost to sale? So fair value is equal to 13,500 less cost to sale is equal to 500. Here NRV is equal to 13,000. We need to recognize at what price carrying amount or NRV, whichever is less. So we show what is the value should be shown in the statement of financial position. How much? 13,000. We have to show at what? NRV. Then how much amount required to be reduced from the carrying amount? So 14,500 minus 13,000, 1,500. This is treated as what? Impairment loss and is transferred to statement of profit and loss. And is transferred to statement of profit and loss as a impairment loss. Okay, this is the first one. Then second, discontinued operation. So discontinued operation is a component of entity that has either been disposed of or is classified as held for sale. It may be a single asset, means major line of asset, or it's a group of assets. It represents separate major line of business or geographical area of the operation and is a part of single coordinated plan to dispose of separate major line of business or geographical area of operation and is a subsidiary acquired exclusively with a view to resale. And the discontinued operation also includes what? Subsidiary acquired with a view to resale. So remember this point. Subsidiary acquired with a view to resale is also classified as a discontinued operation as per IFRS 5. By showing the performance. So so an entity can disclose a single amount on the statement of profit and loss comprising the total of post-tax profit or loss of discontinued operation. Post-tax is nothing but profit after tax or loss after tax is only required to be measured. And post-tax gain or loss recognized on measurement to the fair value less cost to sell or a disposal of asset consisting of discontinued operation. Okay, then so the analysis of the single amount is nothing but what? Profit after tax relating to the discontinued operation must be presented either in notes or on the face of statement of profit and loss. It may be mentioned in either in notes or on the face of statement of profit and loss. Okay. Then this is the statement of profit and loss with the discontinued operation. First, we calculate what is the profit or loss for the continued operation. We add profit from the period for discontinued operation, total profit. Analysis of this amount is provided in the notes or along with the statement of profit and loss. Along with here, we also provide. So this is the one. So Valentine produced the cards and sold roses. However, halfway through the year ended 31st March 2006, the rose businesses was closed and the assets sold off incur the losses on disposal of non-current assets 76,000, redundancy cost 37,000. The directors reorganized and continued business at a cost of 98,000. Reorganized, continuing the business at a cost of 98,000. So then Cots and Roges data is provided relating to the revenue, cost of sales, distribution, administration, other trading information, finance cost, and tax. So draft the statement of profit and loss for the year ended 31st March 2006 and so how to prepare draft the statement of profit and loss. So statement of profit and loss, first revenue. So here what is the continued operations? Continued operations are costs and Roges are discontinued operations, right? Rose business was closed. Discontinued operation is road. So revenue is 650 less cost of sale 320 less cost of sale 320. Then the difference is 330 is the gross profit less distribution cost 60 and administration cost 120. So right, then total 180. So 330 minus 180 equal to how much? 150. This is what operating profit, nothing but EBIT less finance cost. Finance cost allotted to continuing operations is provided 17. Then finance cost is 17. So finance cost is 17. And then how much? So 150 minus 17 equal to 133. Along with that, he clearly stated the director reorganized the continuing business at a cost of 98,000. So we have to consider at a cost of 98,000. We have to consider that reorganized cost 98. Then EBT. So how much? 35. EBT is equal to 35 less tax. Tax how much? 31. So profit after tax 4. This is about what? Continuing operation. We have to add profit after tax for discontinued operation. Then how to calculate the profit after tax for discontinued operation? Same thing is required, but we have to give in notes on accounts or along with statement of profit and loss. So in case of the Roges, then same we consider revenue, how much? 320 less cost of sale 150, nothing but what? 170 is the gross profit. 170 is the gross profit. Then we reduce what? Administrative cost and distribution cost 110 and 90. Then so loss equal to operating loss. So 200 minus 170, 30 is the loss. So 30 is the loss. Then what is the another cost? If any here clearly stated redundancy cost. Redundancy cost is 37,000. So total redundancy cost is 37,000. Then total 67. 67. And another one is losses on disposal of non-current asset 76,000. So loss on disposal of non-current asset 76. Then total loss. So 143. Total loss is 143. So that 143 is added here, reduced here. So less loss from the discontinued operation is equal to 143. 143 minus 4. The total loss is equal to 139. Total loss is equal to 139. In this way, first we calculate profit from the continued operation, then we add the profit from the discontinued operation. Here the profit or loss from the discontinued operation, whatever we have is calculated separately in notes on accounts. Separately in notes on account. This is about what? Discontinued operations. coming to the MCQs, according to the IFRS 5, non-current asset held for sale and discontinued operation, which two of the following relating to criteria of an asset held for sale. So first item must be major line of business or geographical area. This is what discontinued operation, not relating to asset held for sale. Next, asset must be available for immediate sale. This is correct. So when the sale is being probable, in that case, one of the condition is asset must be available for, relating to the non-current asset held for sale, it has to satisfy two conditions. One of the condition is asset must be available for immediate sale. Sale is expected to be completed within next 3 years, not within next 3, not within 3 months, within 1 year. Reasonable price has been set. So the reasonable price has been set. So this answer is correct. So the reasonable price is nothing but what? Fair value. So option is B and B. Next. According to IFRS 5, non-current asset held for sale, discontinued operation, which of the following amounts in respect of discontinued operation must be shown on the face of the statement of profit and loss? Nothing but what? Profit after tax. So 3. So only 3. B. Next. So according to IFRS 5, so how should the non-current asset held for sale is valued? Lower of carrying amount and fair value less cost to sale. Nothing but B. Nothing but B. Next. So halfway through an asset identified as an asset held for sale after meeting the criteria according to IFRS 5, non-current asset held for sale and discontinued operation. At the start of the year, carrying amount is 1,50,000. Original cost is 2 lakh. Asset is being depreciated on straight line basis. Asset is being depreciated on straight line basis. Then asset, what should be the depreciation expense for the year B? So what should be the depreciation expense for the year B? So what is the amount of original cost 2 years ago? 2 lakh. 2 years ago. So what is the remaining life of the asset? So here number of years is not provided. So 2 years ago 2 lakh. At the present how much? 1,50,000. Means for the 2 years the depreciation charged is 50,000. 50,000. But he clearly stated he follows the straight line method, means equal depreciation. This is for 2 years. Then per year depreciation is equal to 25,000. Per year is 25. But in the current year, only in the current year, so the current year. So halfway through the year, asset is identified as non-current asset after meeting the criteria as per IFRS 5. So in the current year, what is the depreciation? So here in the current year, halfway through the year, nothing but half of the year is only utilized. Nothing but we need to provide the depreciation for 6 months. Per year depreciation is 25,000. Then for 6 months, 25,000 into 6 by 12, 12,500. This is the depreciation charge, 12,500. Next. At the reporting date, asset is identified as an asset held for sale after meeting the criteria according to IFRS for non-current asset held for sale. So where there should the asset appear on the statement of financial position. So in case of IFRS for non-current asset held for sale, it is shown as a part of current assets operation. Next. CAT has a year ended 31st December on 1st January 2009. It classified one of its freehold property as held for sale. At that date, the property had a carrying amount of 6,667 and has been accounted according to revaluation model. Its fair value was estimated at 8,25,000 and cost to sell is 3,000. So here the carrying amount is 6,67,000 and the revaluation of asset is 8,25,000 minus 3,000, nothing but how much? 8,22,000. 8,22,000. In case of revaluation model, asset should be revalued. Asset should be valued at revalued figure. Nothing. What is the revalued figure? 8,22,000. So 8,22 minus 1,67,000. So 8,22,000 minus 6,67,000 equal to 1,55,000. 1,55,000 is the revaluation gain. 1,55,000 is the revaluation gain. Then how to represent? First, if the land property is classified as investment property or property, plant and equipment. If it is classified as investment property, that is accounted as per IAS 40. It is classified as property, plant and equipment, that is accounted as per IAS 16. In case of IAS 16, the revaluation gain transferred to revaluation surplus and is shown along with other comprehensive income in the statement of profit and loss, along with statement of profit and loss. In case of IAS 40, that revaluation gain is transferred to statement of profit and loss as a other income, not other comprehensive income. It is transferred to as a other income. So nothing was stated. Nothing was stated is treated as PPE. In case of PPE, so in case of what nothing was stated, that is treated as what? PPE. In case of PPE, what is the revaluation gain? What is the revaluation gain? So revaluation gain is equal to how much? So if you divide it individually, what is the revalued figure? 8,25,000 minus 6,67,000, 1,58,000. This is what revaluation gain. This is what revaluation gain. Then, so this revaluation gain is transferred to what? Other comprehensive income. Other comprehensive income. Then what is the cost to sale incurred? That cost to sale is 3,000. So revalued figure is 8,25,000, or what is the NRV? 8,22,000 or fair value less cost to sell. So then whichever is less, 8,22,000. Then the decrease in value how much? 3,000 is treated as impairment loss and is transferred to statement of profit and loss. So generally revaluation gain, nothing is transferred to statement of profit and loss. Impairment loss 3,000, revaluation gain is 1,58,000. Okay, now so here, so listen carefully. Revalued amount equal to 8,25,000 less carrying amount equal to 6,67,000. So revaluation surplus transfer to other comprehensive income 1,58,000. This is the first one, other comprehensive income. Next, at what price we show it? Either revalued amount. Revalued amount itself is the carrying amount here in case of revaluation model. Then or NRV, whichever is less. What is the NRV? So revalued amount less cost to sell. So revalued amount is 8,25,000 minus 3. So 8,25,000 or 8,22,000, whichever is less. So 8,22,000. Then the difference amount 8,25,000 minus 8,22,000, 3,000 is treated as impairment loss and is transferred to statement of profit and loss. Okay. Next, for each issue, identify the current accounting treatment in Maderia's financial statement. So a loss-making division which Maderia has agreed to close next year, So it is not treated as an asset held for sale and not a discontinued operation. Next, the factory of Madeira which is being marketed at reasonable price at the year end. which is being marketed at a reasonable price. Marketed means sale at reasonable price at the year end, means in the current year. So it is treated as held for sale, not the discontinued operation. Madeira specialized plant which will be advertised for sale once it has been dismantled. So once it has been dismantled, then only it is held for sale. So it is not considered as a held for sale at present because the property, so that is plant is not readily available for sale. So it is not classified as held for sale and it is not discontinued till now. So neither a held for sale nor covered under discontinued operations. Okay, so this is about what non-current asset held for sale, IFRS 5.